like to begin with the first panel of the day, focusing on mining investment strategies. So please help me welcome to the stage Victor Chin, Principal Consultant at CRU, Scott Clements, Head of Advisory at Tribeca Capital, Bhagesh Desh, Partner at Bromius Capital, and Michael Willoughby, Managing Director, Global Head of Metals, Mining, and Transition Materials at HSBC Bank Singapore. All right, so I guess just to start off the panel, maybe if our panelists want to do a short introduction to themselves and, what are you focusing on? What's your big theme for the day? So Victor.
Should I start first? Okay.
Yeah.
Hi, I'm Victor Chin. I'm a principal consultant in CRU. CRU is a commodities analysis firm. In the consulting part, we do strategic consulting to various mining clients on different commodities. My background actually has been in the finance industry for most of my career before shifting into consulting.
Hi, I'm Michael Willoughby. I lead the global effort in metals, mining and transition materials at HSBC. I was 22 years at JP Morgan, a couple of years at Stanchart, lived in Tokyo, Beijing, Hong Kong, now Singapore, obviously from Australia. Big focus is battery materials, and nickel really in Indonesia, which is the main game. Lithium is a massive problem. And also just the narrative around ESG, carbon abatement's important, but it's not everything because you need an economic alternative. And unless you have the capital to invest in metals, you don't have that economic alternative. So that's a critical push of ours.
Hi, my name is Bhagesh Desh from Bromius Capital. We are a Singaporean-based investment advisory firm backed by a local family office. Traditionally, we focused on mining and metals, but these days we also focus on forestry, renewables, and agri. Like Michael, we are focused very much on environment-related mining projects, so battery metals are a big focus for us.
Hi, Scott Clements from Tribeca. First of all, I'd like to apologize for not wearing a tie. I'm the only one, and I think it's because I forgot how to tie them over COVID, so apologies. So Tribeca is a boutique investment advisory firm. We started on the investment side about 20 odd years ago in Sydney. We managed 3 or 4 billion in assets, and we're pretty active in global natural resources. So we have long-short resources funds. We have a listed product on the ASX, and we have a resource lending fund, and then some thematic funds, which, tying into what some of the other panelists mentioned, we're very much this transition from being a resource investor into focusing on decarbonization. So we set up a nuclear energy fund 3 or 4 years ago. It's done quite well. We have a decarbonization fund, and we also set up a voluntary carbon credit fund a year or two ago. And then in the group, we have a private wealth business, and I'm based here, and I run our corporate advisory business. So I work with some both portfolio and non-portfolio companies generally that are having problems. So thanks.
All right, thank you. So I thought, this is meant to just be a bit of a broad-based panel looking at what's happening in the industry today. So thought we could start with a kind of a global perspective. How is the current geopolitical environment impacting the metals and mining industry? So, things like the Russian invasion into Ukraine, China's commitment to a zero COVID policy, all of these issues. How is it impacting the industry today in terms of investment? What do you see happening? So, Victor, you're closest to me. Why don't you kick things off?
Sure. It's a big topic, obviously. Russian invasions is sort of started the year and sent all the commodities price to historical high, and now you see inflation and then rise in interest rate. So I think at least part of the world is going to go into recession. But I think what's interesting, this part of the world is probably, I'll say the US-China tension that really shift the supply chain to other parts of the world. Here in Southeast Asia, I mean, Michael mentioned about nickel industry in Indonesia. So I think there's a big development there. You see lithium developing in Australia. That's going to be a very similar trend. And I think India, there's also, when you look about it, there's probably new manufacturing sites announced every week now in India. So I think that's a topic to be focused probably in the next year.
I think just on structural drivers, so you've got obviously the Ukraine situation, which to some degree helps the acceleration of transition globally because it highlights, you know, the issue with fossil fuels and the lack of alternative, and you know, hopefully drives more investment in the alternatives, which is principally metals driven as opposed to infrastructure driven, I'd argue. So that's one. I mean, the second thing is, you know, the bifurcation of the supply chains, which, you know, hasn't really happened, but everyone's talking about, you know, between China and the rest of the world. I mean, I think that just creates uncertainty for investment in certain markets because, well, is China a customer? Isn't it? Is China going to overinvest? Isn't it? You know, it creates uncertainty, and, you know, like the metals and mining industry needed more problems with sourcing capital from public markets. You know, there's a few other structural trends. I mean, technology is going to play a big part in delivering economic metals to transition. You know, we don't know what that is yet, but that is really one of the only solutions for the volume of metals that we need from the low-grade sources that we'll process from. So, you know, I hope there's good gains in that technology over the next few years. And then also, I mean, over the last 25 years, you've seen 70% odd of most commodities, the processing going onshore into China, you know, for cost. You know, the cost was so low, and now that's reversing. So now you've got the offshoring a lot of that processing capacity, firstly in Indonesia, secondly in Korea and the Middle East, and you know, other places as battery materials get a critical mass. So that's a really interesting trend to watch.
I think Michael and Victor have covered most of it, but what I'll say is, what I'll add to it is that I think it's also increased the focus of many countries that are actually receivers of commodities to focus on areas which are less prone to geopolitical issues. So you've seen the German Prime Minister, Chancellor fly to Canada and try and see how to source gas supplies from energy from Canada. I think Canada, Australia, and certain parts of South America are now going to be increased focus for investment. And yeah, I think, you know, moving away from places, suddenly people have discovered that Ukraine is the food basket of Europe, and actually all of Putin's threats came to reality, and that he could switch off the gas supplies. So I think suddenly that's brought forward, you know, the Western countries' focus on trying to source alternative sources of critical commodities.
Yeah, I mean, it's tough going last on that one, but I'd say, I guess you know, this is a pretty eventful time to be investing. And, you know, we're at a secular change in interest rates, which, you know, a lot of people in market and industry haven't really had to deal with. And so, you know, you've got that macro volatility, you've got this post-COVID environment that we're in, which is going to have these ripple effects that I think we don't really understand that well. And so, you know, the macro is pretty challenging, but, you know, the two themes that we think are really relevant to, you know, this sector, one is definitely decarbonization as a general term. You know, I think it's not a new thing, but there's consensus now that, you know, from all levels, you know, government, private sector, individuals, that, you know, something needs to be done. And, you know, in the mining industry, we're, you know, like, if you're a optimistic person, you'd say that we're looking at things that we'd never even thought about looking at a few years ago, you know, sources of power and you know, how clean the operation is and how you're treating local communities. And people have paid a lot of lip service to those things for years, but it's, you know, it's you won't get funded, you know, particularly debt funding, if you don't have a pretty good story to tell. So decarbonization is a massive thematic, and it'll survive wars and geopolitical events. And so, investing wise, if you pick the right spots in that theme, you can still do well in a tough environment. And then the second area is we call it de-globalization. This period where the U.S. is not the undisputed geopolitical superpower, and a rising China has created all these ripple-on effects, and and in our industry that's really around putting your supply chain in friendly hands, and which basically means moving your reliance on China out to friendlier jurisdictions. So people will pay up for inferior assets and downstream in countries where they are sure that their supply chain won't get disrupted. So, that's been pretty impactful in our industry, because all of a sudden it's opened up opportunities for assets and businesses in places that, like Australia. There's a lot of downstream activity happening in Western Australia. In Canada, the federal and provincial governments are providing a lot of funding to build downstream supply for the auto industry, particularly in Ontario and Quebec. So, it's never easy investing, and the environment's tough. But I think if you stick to those themes and pick your spots well, you can make a lot of money in an environment where a lot of people are not.
I think just to add to your point, many years back when I was young and investing, and an astute, much older investor told me that, look, Bhagesh, it's fantastic looking at projects in these parts of the world, but I will always put my money into projects in Australia and Canada, certain parts of Canada, because I know that, the geopolitical risk is lower, and there is a reason why, they attract risk premium or a premium on pricing.
Just kind of following on from what Scott was mentioning about the supply chains and this kind of deglobalization of the industry. I think also, in the U.S., this focus with the Inflation Reduction Act, bringing in this focus on kind of all of the materials being sourced or processed within the U.S. How do you see this kind of regionalization of the supply chains playing out?
Well, that's going to be interesting because, it was a pretty impactful piece of legislation they put out in the U.S., but the issue is that the U.S. is not a very easy place to get permitting for new mines, and there's a lot of NIMBYism in different states, and so our read on that was it's going to be very good for countries like Canada and Australia that are friendly and close enough, have resources. Australia is massively underexplored in many cases, even though it's a huge producer. Canada's got trade agreements with the U.S. in close proximity to the end users. So, it's going to be, I think, probably less impactful for people developing projects in the U.S. than in friendly neighboring countries, I would say.
I might take not an opposite view, but a kind of a different view. So if you're a Western capital markets investor, mining is hard. Mining's really hard. You're happy to put trillions of dollars into infrastructure at pretty low returns, but as soon as you put commodity price risk in there, no, not interested. And that's true of sovereign wealth funds, public equity funds, the US, capital markets, basically, outside of high yield bonds. And so what that's meant in the last 10 years, after the China super cycle, there's been very little investment. And even now, when it's clear there's not enough supply in many commodities, most of the big miners are still giving capital back to shareholders, and they're not encouraged to take risk on new projects or growth at all. So they generally don't. They put lip service to it, but it's you've got to be heroic to go against the majority of your shareholders. So where's the capital really coming from? If it's not coming from Western capital markets, which is not. I mean, if you look at all the statistics, basically none of it comes from the US. Very little comes from Australia outside of the retail shareholders and small cap investors. It's China, full stop. So, and you think, well, why aren't commodities going up more? Because that's what usually happens right now in the cycle. And yes, there's a demand issue, with the geopolitics, but it's because China's been investing huge amounts of capital and supply over the last 5-6 years. It's just Western markets don't see it. I mean, let's look at nickel. So China's invested $30 billion just in nickel, just in Indonesia. Indonesia produces 1 million tonnes per annum of contained nickel. Australia produces 160,000 tonnes. In 3 years' time, that 1 million tonnes in Indonesia will be 2 million tonnes driven by the two biggest precursor producers in the world, which is CNGR and Huayou. Right, that's 2 million tonnes versus Australia, which probably wouldn't have changed its total output of contained nickel because, I mean, look, it's fairly difficult to start up projects quickly in most jurisdictions. So, if you're a car maker looking at that, you're going, well, yeah, I like investing in Australia and Canada and the US and the rest of it, but I don't want commodity price risk, and that's not big enough to solve my problems. So they are forced to now take stakes in China-sponsored projects in Indonesia for the volume, and they are doing that, and it's big capital. And Western markets are basically carved out of that. So that's a big challenge for Western markets over there. And you can say exactly the same thing for copper in Africa. China's put in $30 billion of capital into Africa in copper in the last 3 to 4 years. I mean, that's had a huge change in the volume of, or the supply-demand balance. So, I think that's a big structural issue that Western markets need to address.
I guess, Michael, the question is, how are the Americans going to deal with and be consistent with the act, right? And how are they going to be able to source material from the US? And I think what I guess Scott and I are trying to say is that they're going to try and source it from friendly countries, because America has lost, the ability to downstream process a lot of minerals as well. I mean, they pass the rare earths technology to the Chinese, and they don't have the investment in the downstream sector.
So in 15 years, you might be right. There might be a material amount of new product from the US. There certainly will be from Australia and Canada, but it still pales in significance versus some of the other countries like Indonesia. And, is Indonesia part of the act or isn't it part of the act? Because they've made it deliberately opaque. And, if Tesla and Ford, and GM are big investors in the assets in Indonesia, do you think they're still going to put that tax on them? Don't know, and that's why they've made it opaque. Those end consumers certainly don't think so, which is why they're investing.
I think you're right, Michael. What's going to happen is we talk about a lot moving the supply chain outside of China, but what's behind those countries is still going to be China, and that's a lot has to be both capital and technology. Right. I don't think, and also the speed of acting. We really do see project being announced every month, and you're right, it's all Chinese. So, but we look at how sanction on Russia works. Right. There's always a way around it. I don't think it's effective anymore. So I think similar things going to happen. You're not sourcing from China, but you're sourcing from companies that's invested by Chinese. Yeah.
I just want to let our audience know that we are taking questions throughout. So if you do have a question, just put up your hand. We have a microphone at the back of the room. So at any point during this discussion, definitely feel free to just put up your hand and ask a question. Yeah, okay, we have one already.
Yeah, thanks taking that chance. My name is Oliver. From Cronimet, the German commodity house. Just on that point of securing supply chain access, and China is giving us good examples, as you explained, what would be your thought around the requirements that maybe project developers on the mining side or refiners would have to fulfill, that groups, we see that with Tesla reaching out, we see that with Volkswagen reaching out and others. But what is a trigger point when this will really be realized? Because likewise, a lot of lip service, they understand the complexity around, let's say, securing raw materials, but no real project set on the ground. So what would be your recommendation to the developers on the one side or established refiners to basically close the gap to get industrial groups really investing into projects?
Well, I'll have a go. I think it's interesting. It depends on the commodity. If you're talking about lithium at the moment, the end users, the auto manufacturers, I mean, they're looking all the way up to the mine level at the assets, and they're all pretty actively engaged in looking at the projects, and the reality is it's hard to fund projects that are not environmentally good these days anyway. So, no, they're very engaged all the way up, and we're seeing end users invest upstream early stage assets so they can, I mean, it's a hedge, but they also want to make sure that they're involved in the development process. But at the end of the day, I mean, there is a lot of concern around securing materials for 10-year production cycles if you're a manufacturer. And so, I think the reality is people will be a little bit flexible on these things, just in order to make sure that they're going to go to market. I mean, we have clients in Europe that are downstream players, and, they're looking at upstream assets in Africa, countries in Africa that, a couple of years ago they wouldn't even think about because they just want to, have access to it. And they're engaged with the companies, and a lot of them have renewable power, and they're, doing the right things in the community, et cetera, et cetera. But, the end users are willing to push the envelope a bit at the moment. That's, I think, what's very clear in the market.
I think one interesting thing I'm seeing is certainly, and Michael may add to that, is in the Indonesian nickel space, the government, the president himself, and the Ministry of Trade and Industry have made visits to the US. They've gone to the Tesla factory. They've made a big push to promote Indonesian nickel. And, they have plans of, bringing the downstream side of this industry to Indonesia itself. The ministers are getting behind it, and some of the nickel companies are, tying themselves up to the government and trying to make this push to make Indonesia sort of the EV capital of Southeast Asia or Asia anyway. So I think that's another factor that will help, the government policy support.
So, I mean, each commodity is different, but nickel's a really good example because it's a complex midstream and downstream process. And, I mean, one of the big differences between China and Western markets is China's generally vertically integrated. The person that owns the raw material has economics right up to the car, whereas you look at the Western supply chain, it's, miner, processor, precursor, cathode, cell, battery, car, all different capital structures, all fighting for a piece of the pie. And, I think for a Western markets domiciled developer of an asset, I would encourage them to be a lot more open about how they share the economics with the midstream and the downstream, and how they consider the economics, or of gaining economics in the midstream in particular, because most people in mining in particular are miners, and they want to mine, and they don't want to compromise the end product where they're happy to take the commodity risk up and down. Well, you've got to get there first. And I'd encourage the developers to hitch their wagon to a multitude of downstream and midstream processes and share the risk together, because ultimately the market doesn't want to pay you for commodity price risk. They want to pay for earnings growth and stability, and if you can share in some of the downstream economics, then that actually improves the potential of getting a higher multiple for your business eventually. And I know that's different from the kind of set way in mining, but that's worked very successfully in China.
I guess what's interesting is China actually doesn't have a lot of upstream resources in China, and then you look at Indonesia. What's happening before a few years ago is all the nickel ore shipping back to China to be upgraded. And through regulations, they're able to ban the export ban, and they force the Chinese coming to Indonesia invest in the smelters. So it's not China's voluntary coming in, but it's out of necessity. So if you think about the West holding the resources like Canada and Australia, through regulations, they can encourage development of downstream processing. But one of the things that environment damage of this processing, it's real, and you just have to take a view on which is more important.
Sorry, just onto that point, and thank you, Victor, I forgot. In nickel 3 or 4 years ago when Tsingshan was the only game in town, the feasibility study, really, just build it. Let's see how it goes. That's now no longer the case, right? The new projects are being developed with Western partners, with Western banks, with proper project due diligence, and that's improving all the time. The new HPAL plants will have gas power, not coal power. In many ways, they're going to be cleaner and a lot more efficient than those, outside of Indonesia. So on an ESG front, there's still challenges, obviously, operating in an environment like Indonesia, but it's improved a lot, and it's improved to the standard that Western investors or corporates can invest, which is a huge step.
Just to continue on that theme, looking at the ESG social license to operate issue, but what are the impacts of this kind of growing discourse on ESG challenges that it poses to the mining industry and the investment industry? How does the investment industry kind of adapt?
You go first, Victor.
I guess the first questions ESG fund looking at mining, they have to answer, do we need mining for energy transitions? Do we need materials? And the answer is yes. I don't think we can, the current recycling rate of most materials are so low that we need mining to get to net zero. And so I do think there's a good argument of investing mining even for ESG focused fund. And then the next thing is which commodities can help you get into energy transition, get into net zero, right? So we talk about a lot of nickel, lithium because of EV battery. So there's going to be winner and losers in these energy transitions. And then I think that's the encouragement. Michael just talked about new plant using cleaner energy source. I think that's very important. So encourage investments even in the downstream and upstream to look at energy source. What are they using? Coal? Are they using gas? Are they using renewable? And last thing, I think in terms of mining, one of the things probably that's not talked about it's how the waste treatment part. If you are ESG focused fund investing in mining, you should be looking at cleaner waste treatment options. We're talking about tailing dams, problem in South Africa now, and a lot of new plants in Indonesia, they're using dry stacking, which is much more sustainable. So all of this, I think if ESG fund can look into it, there's a way for cleaner mining. It's not going to be all clean, but you should be investing in mines that mining and processing in a more sustainable way.
We have a question here at the front, if we can get the microphone. It's before we move on.
Thank you. Is waiting a private. In a way, a series of questions all related to risk premiums on multiple areas. First one is on the geography. Australia and Canada seems to have the least risk premiums. What is your view in Vietnam, Thailand, Africa countries? The risk premiums.
I'm gonna try and go first. Sorry, risk premium is in the eye of the beholder, right? So China will put a lower risk premium on Africa and Indonesia than it will on Canada and Australia, which seems preposterous to Western capital markets, but it's perfectly logical from their point of view, and that's fine. And then Western capital markets obviously will have a completely different point of view. Australian investors, for example, taking Indonesian risk, there's the risk premium is infinite, which is just I'd say both ways are not great ways of looking at it, but there's huge biases in the way that it's looked at by investors and capital markets, which, needs to be solved.
I think also you need to look at, where the companies are listed, the profile of the companies. So for example, to your point, perhaps, Michael, Western investors may not look at mining companies listed on the Jakarta Stock Exchange because they don't understand that market, right? I, for example, focus on the TSX, ASX, AIM because, easy to pull up the website, look at the companies, the reports, all of that stuff. Jakarta Stock Exchange, a bit more challenging. But if you look at some of the resource companies on the JSX, they're doing fantastically well, right? Adaro spun out its non-coal business earlier this year, and the share price of that company is up 600%. So, again, it depends upon, who is buying and, your understanding of, that particular company, where it's particularly trading, etc. So, Adaro, non-Adaro Green Minerals or whatever it's called, 600% up, good management, good company, good capital backing. I'm sure HSBC is a banker to it, probably. So, but how many people in this room know about that company, right? It's listed on the JSX.
Yeah, I mean, sorry, I don't think there's any set answer how to measure it, but one other thing I think is important. Like it's also who the local partners are. If you're investing in a Vietnamese company that's got a big state-owned sponsor like Vingroup or something, then I would say that deserves a lower risk premium than something that is a bunch of guys from Vancouver or something, for example. So it just depends, and investors all have a bias and think that it's easier to invest in this place or that place. So it just depends on the investor and the actual project.
Yep.
So the second areas of in terms of risk assignments is in the area of interest, right? We know interest rate is going up, so a lot of MPB probably need to relook at. At the same time, together with the interest rate, Aussie dollars and a lot of currency has gone down. So capex probably would increase. Operating costs may be lower. So how do you factor in all this in the way that you evaluate the mining company, especially the junior miners who are way early? Yeah.
Yeah, I guess it's definitely like if you're a developer who's been trying to get fully funded into production over the last couple of years, it's been tough, right? Costs have gone up. You might have a study done 3 years ago that's no longer valid because everything's 30% higher, right? So what we've seen is particularly in Australia, there's been a lot of those companies that were a developer and they've gone back to exploration, just saying, okay, we don't have the balance sheet to take this to production. We're going to have to keep building the size of the resource, and then someone with deep pockets is going to come in and do the development for us one way or the other. So I think it's predicting currencies is tough. Predicting commodity prices is tough, so I think some companies will definitely get stranded with uneconomic projects in the current environment. That's a big risk for investing in development companies.
I have, I know a friend in this room who would agree with me, and more so than I would. After 20 years of investing and making lots of mistakes, there's only one word really: look at the management. Because somebody told me a long time ago, again, a good management can make a bad project work, or they know when to cut their losses and move on. A bad management can screw up a good project as well. Pardon the language. So focus on management, and if you do that, I think you're halfway there. Then you can look at the project, the geopolitical risk, etc. But first is management.
I think currencies and commodity prices and interest rates to a certain extent balance each other out. So it's important not to necessarily just fix on a hedge, for one or the other, because generally it's going to help you if you stay floating. because they'll balance out. But the one aspect of what you said is costs. And, just to give an example, last year there were 19 mining engineering graduates in Australia, 19. And, in the US, I think there was something like 60 or 80. It's not very many. Now, in China, there were thousands. Okay. But for a project like West Musgrave or, and there's quite a lot of big projects in Western Australia, you need hundreds of mining engineers. This is not simple stuff. And there's no supply of mining engineers. So the costs are going up a lot, and to the point that a marginal project almost doesn't matter what you pay, you cannot get enough talent to have it developed properly. And then you go to the consultants and the consultants go, yeah, we'll happily take your money, but do they actually have the staff to do it on time and on budget? Invariably not. And that's the biggest impediment to faster development in Western Australia in particular, and to a lesser extent elsewhere. And then you've got the whole, costs of yellow goods and costs of construction, which in Canada, Australia, US, is much, much higher than it was. So that's, the risk of CapEx blowouts on new projects is huge.
I think interest rate, it's first time in many years that MPV actually, really need to consider, because for the long time commodities, there's no inflation, right? So I think it really favors current producers, because the one that's producing right now generating cash flow, so they are the driving seats on what gets developed next. So greenfield developers are going to suffer in this current environment, and it's going to be a problem, because some commodities like lithium, 40% of the supply is going to come from greenfield. And are they going to all get developed under this environment? And it's going to be a tough call. So I think the producers are going to have a much better time.
And I have a question of Victor and Darren, who's coming up next from Woodmac, is how do you forecast the lithium price? As you said, 40% of lithium will come from new projects, fine, and that's probability weighted. But that still implies only 35% or thereabouts of new cars by 2030 are going to be EVs, implying 65% are still ICEs. Who in this room is still going to buy an ICE in 2030? The only reason you'll do that is if EVs are too expensive. So if EVs are too expensive, what price does an EV need to be to make me want to buy something that clearly doesn't have a future, which is an ICE? And that's the implied price of nickel and lithium within that EV price should be where lithium and nickel prices. That should be the forecast. But, and we're talking about constrained and unconstrained forecasting. It's I know it's hard to do, but it's that's part of the problem. I would have thought that the forecasts aren't high enough to generate more investment.
Yeah. Very interesting to hear Darren's view too. And the EV adoption, it's gaining pace. I own an EV now too, so I know what your point in terms of what's the consumer will choose when they buy the next car. So, and it's lithium. It's also different from nickel, for example. Nickel has a stainless steel there too. So actually, the price dynamics are not as much. But lithium, at least through next year, we think the current price will hold up. And lithium, there's also a contract price and spot price. We think contract price will stay up there for a while to encourage new developments. But obviously, at the end of the day, from CLU view, the cost of production is going to determine the long-term price. So I think at some point, when you incentivize enough productions, the price will eventually go lower to the cost of production, because currently the cost of producing lithium is not that high. So at some point it will go down, but probably not next year.
Okay, so maybe I'll finish off the question. So the last part is the use of new technology. We see the Explorer using AIs and all the stuff to increase the chance of finding mines, and then at the extractions, ion exchange and all this stuff. So how do you see the new technologies coming in into this traditional business, and especially those that bank highly on the use of technology. Your view on this? Thank you.
I'm not going to comment on explorers and technology. I reckon Scott will know that very, very well. But what I would say is more the processing technology side. So China has invested a lot of money in that, and now you're seeing phase 4 and phase 5 of HPAL technology roll out, which is much more carbon efficient. Much larger, recoveries are much higher. It is good technology, and it's almost you have to have them as a partner, otherwise you're not going to be efficient. And that applies to anywhere in the world. So that's one example of processing technology really making a difference. I mean, there's funds like Breakthrough Energy, which is one of Bill Gates's funds that invest purely in materials processing technology. HSBC, I'll give it a plug, has put $100 or $200 million as an investor in that fund. There's not many other funds that do that, and that's massively critical to particularly lithium, and DLE technology and ways to extract lithium efficiently. Unless we solve that problem, the lithium problem is going to get very big very quickly. But I'm interested in, from the investors' side on exploration technologies and how that's improving.
Yeah, I mean, mining's definitely ripe for technological innovation. The industry's still doing things the same way it was, 50, 100 years ago. Oil and gas had a massive technological revolution with the shale-related technology, but you haven't had something similar in mining. So, it's definitely due, but and there just hasn't been the investment into it previously. Now we're seeing it. I mean, part of the reason there hasn't been investment in oil and gas, you get a very quick cash flow payback on your investment, whereas mining it's infrastructure. It takes, the cash flows way down the road, so it's harder to get people into trying different things. But it's definitely happening now. I don't have any great insight on exploration technology. I mean, I'm skeptical, personally, I have to say. But there probably is some, improved ways of reducing the, physical exploration costs and activity and shortcutting. And guys are trying different things, but I haven't seen anything personally that I think is, game changing. But definitely on the processing side, per Michael, like that's where I think there's massive gains to be made. And, things like, I mean, DLE gets a fair bit of attention because it could be a real game changer for a commodity that has, a projected massive demand-supply imbalance. And, if DLE comes in at scale, then it's a whole new ballgame for lithium. But no one's really done it at scale yet. There are some overly promotional people running around talking about things that will probably never happen, which isn't good for the sector. I mean, I'm working with a private New Zealand company called Geo40 who started removing minerals from geothermal fluids, taking silica out, which causes problems in the efficiency of the plant. They've got a full-scale operation. They're moving to other minerals like lithium and boron, which we're pretty bullish on, by the way, and cesium. And so, but it's boring industrial technology, and there's no magic. You just have to keep tweaking it. You take known processes and things and you just combine them in different ways, and it's different depending on your asset, like any mineral resource. But it could be a real. I mean, the oil field brines in North America are a massive opportunity, for example, because you already have the infrastructure and the permitting done, and you just you're taking brine out of aquifers and processing it, and a lot of those brines do have a lot of minerals in them. So. And you see it with some of the private groups like the Koch Industries, and these guys, they're all over it. They think this is going to be something big if they can crack it at scale. So to me, it's more about the downstream technology than the upstream. I really haven't seen any game changers upstream, to be honest.
I guess I will highlight in terms of the demand side. I think technology can change the demand of materials. Right now, for example, battery, we're talking about NCM, but there are technology that doesn't require cobalt. So I think Western country are, want to figure out a solution that can you build battery without cobalt, and that can have massive implications. Or even without nickel, for example, you can have LFP battery now that doesn't use any of these materials. So I think, and from an investor point of view, you really need to keep track of which of these technology will win in the long run, because that could means big changes to a demand of commodities. And the other very interesting part is the recycling side. For recycling, going to be a big part of the future if we're going to have a circular economy. So that part has a lot of development, and I think you will see a winner in the next decade. Who's going to win out?
All right. So before we start to wrap up, I thought we could just kind of do a little bit of a closing where our panelists talk about kind of what commodities you're most excited about, whether it's, dealing with the commodities involved in the energy transition or gold or whatever else. What are you looking at right now?
Okay. Yeah, well, I'm usually wrong, so don't bet your, kids' college fund on these. But no, I mean, battery materials, you hate to say this time it's different, so I won't. But, in terms of when you see these high prices, they usually don't last. Commodities are cyclical for a reason. It feels like it's going to keep going for a while for battery materials. And I think there'll be a broadening of focus into things like graphite, where that's, I think, going to be a key battery material. I mentioned boron. Boron's used in a lot of renewable technologies. It's used in EV motors. It's used in wind turbines. It's produced in a not very environmentally friendly way in the moment. So there's probably scope for cleaner boron out there. So I think in those areas, you can probably still make money for a while if you're smart about what you pick. I think copper is an interesting one. It's always been viewed as a play on Chinese growth, and it's sort of industrial proxy. But it really is a green metal, and I think it should get re-rated as one over the next couple years, where people talk about copper in the same breath as some of the battery materials and sort of renewable related materials. It's got real supply issues in the copper market. So I think investing in good copper projects will probably work. And gold, I have no idea. I've been wrong on gold the last couple of years, so don't ask me. It's been tough, but we keep hope.
So I think battery metals obviously is a very hot sector and doing well. But because of the greenfield nature of the sector, it's hard to sort of do individual stock picks unless you have a view on whether it's hard rock or brines, and hard rock in Australia or brines in South America, and that requires a bit more technical expertise. I think you can't go wrong with low-cost copper and nickel producers because the size of the market is so big, and everyone needs copper and nickel. Those two commodities are not going away. We've seen lithium back about 5-6 years ago, prices going up. There was a bubble in the market. Of course, now there's a bit more establishment in the sector. But if I was playing it safe, copper and nickel are the two commodities I would play. Like Scott, gold, horribly wrong many times. No idea what's going on. The central banks seem to have a better clue. So I finally exited all my gold positions a few months back. And I'm quite happy about that.
Well, I'm going to be bullish on gold. No, I'd take it a little bit differently. I mean, obviously, industrial metals and battery materials, they're going to be, positive tailwinds. But, I think the way the bulk of the long-only money globally looks at mining is through the lens of coal and iron ore and bulks, right? Massively carbon intensive. Why would I want to be in mining? And if it doubles, well, I'm not really going to miss out because it's not a big part of the index. I think it's less than 1% of the global MSCI. So who cares, right? That's how a long-only investor thinks. and they're not here today because why would you be at a mining conference? What a waste of time. Now, as some of these industrial metals and battery materials and copper become bigger, as lithium has, for example, as an investment class, and become more liquid and more relevant to bigger indexes, and I think we've seen part of the generalist masses go from what I think the UN Director General said, at the start of last year, which is, let's just stop mining, to now I think most people would concede, well, maybe there's a little bit of good in mining, because without an alternative to fossil fuels, driven by metals, you don't really have an alternative. And so I think that narrative is starting to play out, and that will, both lead to more specific non-bulk type mining investments with liquidity, which will promote more investor interest, which will promote more capital going to the sector, which will eventually promote too much supply again, but that's 10 years away. So I think the next 10 years looks pretty good across the whole spectrum, ex-bulks.
Yeah. Before I come, I CRU does have outlook for about 25 commodities for the next 5 years. We think almost 100% of commodities will probably be lower in terms of prices next year. I think that's two really stand out. I think copper didn't gain. I think from all the other, compared to all the other commodities, copper is probably one that going to recover and going to have a pretty good future. And the other one I mentioned about lithium is I think lithium for the next year should still be holding up. So I think that's the two commodities I will look at right now. And I'm very excited about the lithium development in Australia. It really mirrors a lot of what Indonesia has done. And there's still, I think it's still early stage. There's still a long way to go of what they can be in the next 5-10 years.
All right, great. And we should be getting more into these topics at the battery metals panel, which is going to happen after the break. So that wraps up this opening panel. So I'd like to thank Victor, Michael, Bhagesh, and Scott for joining me on stage this morning. Thank you.